Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. The recent move up was dictated by two key pieces of action in mid-June, a pair of opening long white Marabozos. The second one punched up through some key resistances, consisting of the combination of the base of the late 2022 descending triangle plus the lesser Fibonacci line, both at 1378. These turned from being resistances into supports. However, that did not mean they were not tested once again, as at the end of June we saw the market test lower. The next moving average below, well, the flatlining short-medium moving average, currently at 1367, that held up the market and prices punched back up again, what turned out to be a weekly key reversal up. This was not the only time the short-medium moving average would prove its importance, as we shall soon see. Anyway, this move up also punched through and closed over two key resistances: the declining medium moving average, currently at 1400, and the flatlining long moving average, currently at 1441. The latter had been effective as a cap on the market throughout June. Now, the separation of these two moving averages after they had formed an earlier dead cross, only a few weeks prior, at the start of June, no doubt assisted in the market breaking up through them. Their individual powers could not match the sum of when their powers were combined. This led to the hesitation we saw in July, primarily constructed by the combination of the 50% Fibonacci line of the big December 2020 to February 2022 move at 1451, and just beyond it, another big 50% Fibonacci line, this time from the February 22 to May 2023 move at 1476. Between these two, and I suppose also the long moving average, which sometimes acted as a base, the market was slowed in its rise and eventually stopped. Now, we did see the market punch up through the 50% Fibonacci lines, but it had a real problem stabilizing over the one at 1476. Such that when changeover came, we ended up with a gap down, the lower end of which was back down around the medium moving average. There has since been a recovery, filling in the changeover gap. This now leads us to what the recent late June to date action could be, or should I say, could be seen to be. 2 weeks ago I spoke of an idea, and I quote, "If you look back late March and into April here, you will see we made a double top, with the highs being based around on the 1500 area." Well, the recent action bears a strong similarity to that action. So the question is this: do we have a similar double top now? End of quote. The answer to this was yes. We did have another similar double top formed over the first half of July. Okay, so over to some new ideas I put forward last week, and they are twofold. The first one is to look at the late June to date action as an ascending triangle. I said the following on this idea last week, and I quote, "This has some merit, though it is not a very good looking pattern. We are still within the ascending triangle, so no targets as yet. However, I can lay out some potential sizes for the moves, should they happen before my next commentary. Thus, the primary move topside, such a pattern would be 108 cents on top of the confirmed break, for a secondary harder reach move of 154 cents on top. Primary move downside for such a pattern would be 68 cents off the confirmed break, for a secondary harder reach move of 154 cents off a confirmed break." End of quote. Over this past weekend we had a confirmed break lower, and those potential sizes became a primary target of 1364, with a harder reach secondary target X in the 1278 zone. As you can see, it took all of one session to reach down to the primary target at 1364. But then we have gotten held up, or rather I think it would be more accurate to say the market has gotten itself clogged, as it seems now to be supported by our old friend, the short medium moving average, currently at 1367. I said it would pop up again. And ultimately capped by the medium moving average, currently at 1400. Until we see which way the market goes, whether it is to form a base for a pullback up or a hesitation for a bear flag, Until we see which, then these two will reign. However, before I finish, let me recap the second idea I spoke about last week, and I quote, it was to look at the whole mid-March to date action as a possible, very large reverse head and shoulders pattern. It is still too early on this one to verify such a pattern, but it is worth considering, though the one key point against it is the location of this pattern. It does not look close to a bottom. As the November 2021 low, the 2021 low indeed is actually lower. However, I would keep this idea in the back of your mind just in case. And that's the end of the quote. Chicago soybean meal. The biggest pattern here had been the May 2022 to date broken, then repaired, then broken again, and now the desperately repaired again, sending expanding wedge pattern. A huge pattern I pointed out many months ago. It was never a perfect pattern by any means, but it's finally started working in late May this year. To assist you in seeing this pattern, I've highlighted it on my daily chart in dark blue. However, the upper trend line is slowly exiting out of the market top left, though the lower trend line, currently at 429.10, is still here and is still very relevant to the current market. There's also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. The original break lower this past May, below this trend line and neckline combination, indicated a potential primary target that is still well off the bottom of my daily chart at the incredible 324 zone, and a secondary, harder to reach, much harder to reach target in the 283 zone. These are the ones you can make a note in your diary and maybe look at once or twice a year. However, with the resurgence back up in mid-June from the double bottom, Adam and Eve type, this has postponed any potential big picture targets below for the moment, and instead concentrated vision on the top side. Thus, from the double bottom, the market had punched up and closed over the following: the 50% Fibonacci line, the October 2021 to March 23 move at 403.60. The short medium moving average, currently 410.20. The declining medium moving average, currently 425.40. The lesser Fibonacci line, that's an important one, at 425.90. The neckline I've mentioned, of course. The combined congestion made up from the early April 2021 high and highs from January and February 2021, all at 433.5. The ever so slowly rising long moving average, currently 437.5. And finally the April 2021 high at 439.30. Now, we were last week in relatively open area overhead, all the way up to just shy of the 2021 high at 471.40. However, the hesitation we saw throughout late June and July, which looked for a long while like a possible topping action, has given way to another pattern, one I highlighted 2 weeks ago, and I quote, "Please bear in mind, though I haven't drawn it as yet, the action since mid or even late June has a strong possibility of being an ascending triangle, such that I would watch carefully any moves lower, just in case." End of quote. Last week I formalized this pattern, which is highlighted in bright red on my daily chart, and it comes to an apex today. And this is where it gets cloudy. You see, last week the market broke higher out of this pattern, but at the end of that week the market formed a 3-day bearish evening star pattern, which had exploited this past Monday, pushing this time below the ascending triangle. However, the combination of the neckline and the declining medium moving average and the lesser Fibonacci line at 425.90 all managed to halt and eventually turn the decline back up. I told you that lesser Fibonacci line was going to show up again, though not by much so far. Thus, we have had both a false break higher and a false break lower out of this ascending triangle pattern, and we are now out of it. So what now? Well, for the moment, until this cloudy nature clears up, I'll reprise my comments from last week and add some new ones. Thus, and I quote, "For a break higher from an ascending triangle, we would have a primary target, now target X, in the 458.5 area, with a harder secondary target in the 471.5 area. Interestingly, the latter is coincident with the next significant resistance overhead, and that's the 2021 high, end of quote. It seems only appropriate with a false break lower. Top also include on the downside the markets for an ascending, to also include on the downside the targets for an ascending triangle. Therefore, a primary target will be down in the 408.60 zone, with a secondary harder to reach target in the 381.30 zone. I haven't labelled any as target X's as yet on the downside, purely, or even on the top side really, purely because of the false breaks. But I would not on the secondary target below is consistent with, I would note on the secondary target below it's consistent with the support at 381.40 and the lows of May and June. This brings me once again to my final point, which I raised 9 weeks ago. You see, on my longer term monthly charts with just over half the year gone, 2023 is set up to possibly be an annual key reversal. Thus, if you were to close on New Year's Eve either above 471 even or under 399.10, then we'd be on. Anything in between would have a lesser outside year. Right now we're looking at a possible outside year, but we still have so many months still to go. Chicago soybean oil. The key pattern here, which I highlighted a good while ago, is the late November 2022 to early June 2023 descending wedge pattern. This is easily seen as it's highlighted in purple on my daily chart. It is not a perfect pattern. You could hardly expect it to be after over 6 months of continuously watching the market try and thread in between the two trend lines. However, 8 weeks ago the market broke up and out of this pattern. So for such a confirmed break higher back then, I'd previously highlighted a primary target X in the 67.5 area, with a secondary harder to reach target X1 for such a pattern in the 78.20 area. Last week prices reached the primary target and drove a little higher through the July 2008 high at 68.13, but were halted and started retracement by the June 2008 high at 69.12. Last week I took the opportunity to draw a bullish shift pitchfork for the action from the last day of May to the latter part of June. You'll see this pitchfork highlighted in bright red on my daily chart. It seemed to be a reasonable pattern, dipping, but this week prices broke out and down and out of this pattern, dipping below the 50% Fibonacci line of the January 2021 to April 2022 move at 64.09. And today again testing lower. So what now? Well, we might form a July today head and shoulders pattern, but I will reserve my thoughts on that until I see some more action in building a second shoulder. In the meantime, we'll have some potential targets below for a break of this bullish shift pitchfork, but treating it as a bull channel. Thus, a primary target X2 would be in the 59.20 zone, 59.72 zone, my apologies, with a harder to reach secondary target down in the 48.13 zone. I should emphasize that these two pattern targets are only there because of the break of the pitchfork. Now, one final thing, and it's something I mentioned 5 weeks ago and have ever since. It was this, and I quote, I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern, end of quote. I'm not going to expand on this idea any further at this time, but I wish you and also me to just keep this in mind, especially as such a drop as we have seen last week and this falls well into such a pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.